Gold prices near all-time highs. Amid central bank buying, global uncertainty, and dollar weakness. April 16, 2025 As of April 16, 2025, gold continues to trade near its highest levels in history, underpinned by a complex mix of global economic uncertainty, rising geopolitical tensions, central bank accumulation, and sustained weakness in the US dollar. On Tuesday, June gold futures on the COMEX settled at $3,236.10 per ounce, a slight decline of 0.26% from Monday's record-breaking close of $3,200 par $60. Despite this modest pullback, gold remains in a strong uptrend, having surged nearly 19% year-to-date and posting 21 record settlement highs since the start of 2025. This remarkable performance has made gold one of the top-performing major assets this year, outpacing global equities, bonds, and even cryptocurrencies. The metal's role as a safe haven asset is once again in focus as investors seek stability in a highly volatile macro environment. Global central banks fuel demand. One of the most significant drivers of the current gold rally is central bank buying, which has continued at a historic pace. According to the latest data from the World Gold Council, WGC, global central banks added a net 49 metric tons of gold in March 2025, marking the fifth consecutive month of net purchases. The largest buyers include People's Bank of China, PBOC, continuing its effort to diversify away from U.S. Treasury holdings. Central Bank of Turkey, responding to persistent inflationary pressure. Reserve Bank of India, gradually increasing its gold reserves as part of long-term asset rebalancing. Since early 2022, central banks have been steadily de-dollarizing their reserves, a trend accelerated by Western sanctions and growing multipolarity in global finance. Gold, with no counterparty risk and universal acceptance, has become the preferred store of value. Central banks are now acting less like market participants and more like strategic accumulators, noted Layla Hoffman, precious metals analyst at Geneva Commodities. They're not trading gold, they're hoarding it. Institutional investors flock to gold, ETFs beyond sovereign demand. Institutional interest has also picked up sharply. The SPDR Gold Shares, GLD, the world's largest gold-backed exchange-traded fund, recorded over $1.3 billion in inflows last week alone, marking its strongest weekly performance since mid-2023. Hedge funds, pension funds, and asset managers are increasingly allocating to gold as a hedge against both inflation and market turbulence. With U.S. inflation proving stickier than expected and equity markets showing signs of fatigue, gold is re-emerging as a critical portfolio diversifier. What we're seeing is a convergence of narratives, said Richard Kim, portfolio strategist at Axis Global Advisors. You have inflation, geopolitical instability, and a probable Fed pivot, all of which support gold. The Fed's dilemma and the weakening dollar. The Federal Reserve's monetary policy trajectory has also played a significant role in boosting gold. After raising rates aggressively through 2022 and 2023, the Fed has signaled a more cautious stance in 2025. With recent economic indicators pointing to softening job growth and mixed inflation data, markets are now pricing in a 65% chance of a rate cut by July. Lower interest rates generally reduce the opportunity cost of holding non-yielding assets like gold, making the metal more attractive. Additionally, the expectation of easier monetary policy has pressured the US dollar, which is now trading near a 14-month low against a basket of major currencies. When the dollar weakens and real rates begin to decline, gold tends to outperform, explained Morgan Ellison, FX strategist at Broadview Capital. And that's exactly the macro backdrop we're seeing right now.
Geopolitical risks. Keep the bid under gold. The world is also facing a confluence of geopolitical tensions that are contributing to gold's appeal. Flashpoints include Russia-Ukraine conflict, with NATO tensions at their highest levels since the Cold War. Middle East instability, particularly the proxy conflicts involving Iran and Israel. Trade friction in East Asia, especially between the U.S. and China over Taiwan and tech exports. Each of these factors introduces elements of uncertainty that push investors toward assets with intrinsic value and no default risk. gold being the primary beneficiary. Furthermore, global debt levels continue to climb, and concerns around fiscal sustainability in both developed and emerging markets are resurfacing. In such an environment, gold's role as a non-sovereign store of value becomes critical. Technical analysis. Can gold break above $3,300? From a technical standpoint, gold remains firmly bullish. The metal is trading above its 50-day and 200-day moving averages, while the Relative Strength Index, RSI, hovers just above 70, signaling that momentum remains strong, though slightly overbought in the short term. Key levels to watch. Immediate resistance, $3,250. Next target, $3,300. Psychological plus round number resistance. Support, 3,190. Last consolidation zone. Many traders believe that a decisive breakout above $3,150 would trigger a fresh wave of momentum buying, possibly pushing prices toward $3,350, $3,400 in the medium term. Conclusion: gold's resilience in 2025 is not merely a function of price speculation. It is a reflection of deep structural shifts in the global economy. From central bank accumulation and institutional repositioning to monetary policy, shifts and rising geopolitical tensions, gold is now responding to a perfect storm of macro catalysts. As long as uncertainty reigns and the dollar struggles to gain footing, the gold bull market is likely to continue. While short-term corrections are natural, the broader trend appears to favor continued accumulation and new highs in the coming months. Thank you for watching. Subscribe for more financial insights. FinBrief.